Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Good to have you with us again. Please don't forget to like and subscribe. Click the bell so that you get a notification every time we release a new video. I'm sitting today with Nick Rogers, Portfolio Manager at Harvard House. Nick, thanks for joining us.
Pleasure, Robin.
A couple of weeks ago, we kind of visited this idea with Michael of the discount and the jump in the share price of Prosus as a result of their announcement. I think we'd really like to kind of look at that a little bit more. One of the questions is that the businesses underneath obviously has this big holding in Tencent, but it's got all these other online businesses. And I think out of the results, what has been of concern to some viewers is that those other businesses aside from Tencent are not making any money. In fact, they're chowing, if you would excuse the term, an awful amount of cash in building their businesses. How do we see that, and why do we continue to invest in Prosus in that perspective? Nick, maybe help the viewers understand a little bit better, please.
Sure, Robin. So if we look at Prosus as an entity, it is, as of I think yesterday, it was the 40th largest company globally based on market cap. So we're dealing with a massive company. And these companies take years and years to invest into underlyings. They've obviously, their best investment ever was into Tencent. And that supported the share price and is causing the sort of concern at the moment that we're relying too much on the past. There's a big e-commerce section below Tencent, which, if you think of companies like OLX, Takealot, Udemy, PayU, there's a whole lot of very well-known companies below that, but a lot of them are at break-even or loss-making. So I think just to go into that a little bit, it takes a lot of money to build these brands, and they're trying to go globally. So you've got huge investments across the world. Takealot, for example, you've got to build warehouses across the whole of South Africa. You've got to advertise. You've got to get massive software on board to run the business. And I think it's just break even at the moment. So Takealot's been around for a long time, but just breaking even at the moment. But that said, there's huge potential once you get scale. So I think it's a patience game, and I think management who were incentivized, probably incorrectly, towards transactions and sales, have now been incentivized towards reducing the net asset value, the discount, and making sure those loss-making businesses are focused on. So there has been a change, and there will be a change going forward on the tail, as we call it, of Prosus.
So Nick, just off camera, before we started this segment, you were explaining to me a little bit about the discount and maybe illustrating it for the viewer. Many people might not understand how when we talk about a premium to net asset value and a discount, can you maybe just detail that a little bit so the average viewer, average investor could understand a little bit more what that really means?
Sure. So if you look at Tencent in terms of Prosus, Prosus owns 29% of Tencent, but that equates to 125% of the net asset value of Prosus, which means that you're getting everything else for free below that. We know how many shares Prosus holds. We know the share price of Tencent in the market daily. So if you multiply the two, you can get the number. And so trading at a discount, it got to, I think, 60% or 61% discount, means that you were so far below the value of Tencent without the others being involved that something had to be done to close that gap. And that is what management's done. So they're looking at a share buyback that will continue for the next 2 years at least. And a share buyback, if you think very simplistically, if a company is worth 100 Rand and you have 10 shares, each share is worth 10 Rand. If you then buy 2 of those shares and cancel them, you're dividing 100 by 8. So it means the share rises up to 12 Rand 50. So that's a very simplistic way to see how share buybacks can enhance the value. and it's a more tax efficient way than paying out dividends. So it's a different way of doing that. But the end result is to get the share price back up. In terms of the next year or so, I think there's going to be focus on the loss-making businesses for sure, but I do think that everything is going to be outweighed by the share buyback because of the magnitude of it, and also because Tencent is still at a very low price. It's been hammered by the Chinese regulators. It's been hammered by the sentiment on IT stocks globally after the Nasdaq has come crashing down, and then it's been negatively impacted by the new news of COVID in China, where you might have 100 million Chinese back in lockdown.
Wow.
So if you look 12 months out, COVID recedes again. The Chinese regulators are pretty much bottoming out on the harsh measures they put in the past year, which has hit Tencent very hard. So you'd imagine that Tencent will, as a share price in a better environment, actually move up. And the selling down of Tencent, we're not talking about 29% down to zero. In fact, we're talking it down to about 25%. So it's not going away by any means. And the actual share buyback increases the amount of Tencent in the NAV. So it is a win-win. But I think over the next 12 months, we're looking more at the bigger picture having an effect rather than the loss-making smaller companies in the background.
Fantastic. Nick, thank you so much for giving us some more detail and helping us to understand why Prosus is part of what you're putting in people's portfolios. Thank you for joining us, and see you next time. Thank you. Bye-bye.